Navitas Semiconductors.
Right.
The thesis is basically that the company is in the middle of this huge pivot from consumer electronics to what the report calls Navitas 2.0. Yeah, a pure play on AI infrastructure and EV power. The headline is pretty bold. The most underrated turnaround story of 2026. And the core of that argument is that the market is just completely missing the boat. It's still pricing Navitas like a mobile phone charger company.
While totally ignoring this new focus on the high voltage stuff, the 800-volt power solutions that, are basically required for next-gen AI data centers.
Yeah, and I have to say, the structure of the report is really, really clear.
I thought so too. Framing it around the 3 pillars of the bull case, that's a great way to start. It gives you a roadmap right away.
Absolutely, and it makes a really smart move right out of the gate. It tackles the #1 risk in any turnaround play.
Liquidity.
Exactly. It highlights that, roughly $250 million cash position and 0 debt.
Establishing that fortress balance sheet up front is it's crucial. It kills that immediate existential worry that they're just going to run out of money halfway through.
Right, it lets you stop thinking about survival and start thinking about the actual upside, which is the whole point.
So a very solid foundation.
It is, but let's talk about building on that foundation. Our first point is about making the analysis more robust by bringing in the counter-narrative.
I see what you mean. The fact that it's explicitly labeled a bull case.
Yeah, it's honest, but it might unintentionally signal a lack of, comprehensive due diligence to a more skeptical reader.
They'll immediately assume you're glossing over the tough questions.
And that's the weakness here. It's not enough to just say Wall Street is looking at the past. That's too broad. A really strong analysis anticipates the specific bear arguments.
And dismantles them.
Right. Before the reader even has a chance to think of them.
So the suggestion is structural. You'd add a brief, very targeted section, maybe call it mitigating the bear case.
Exactly. And in it, you outline 1 or 2 of the real specific risks.
And then you immediately pivot to show how the data, that balance sheet, the partnerships, makes those risks manageable. It just elevates the whole piece from advocacy to authoritative analysis.
You have to name the risks to neutralize them.
Okay, so let's take a concrete example. Competition. In this space, there's always a risk that some competitor X just accelerates their 800-volt rollout and steals share.
Sure, that's a valid concern.
So you state that risk directly, but then you pivot. You emphasize that Navitas' advantage isn't just their tech, it's their official partnership with someone like NVIDIA. That status suggests that critical design wins have already been locked in, which makes them incredibly sticky. The partnership is a shield. You have to use it that way.
Okay, turning that partnership into a defensive moat. I like that. What about the financials? The really ugly near-term numbers?
That's the other big one. That kitchen sink Q4 2025 guide of only $7 million in revenue.
Yeah, that's going to scare people.
The fear is that it extends into early 2026 and the stock just languishes. You can't just ignore that number.
So how do you frame it?
You have to frame it as an intentional, strategic reset. You explain that the quality of the revenue they're now chasing, these AI and industrial contracts, has way higher margins and is much stickier.
So you argue that the nominal quantity is volatile, but the quality is fundamentally superior.
Exactly. The argument has to be, we deliberately sacrifice low-quality, lumpy volume for high-quality, strategic contracts. It was a tactical choice. That reframing is key.
Okay, let's move on. Our second point is about sharpening the valuation gap by quantifying what this AI capture actually looks like.
Right. The report does a great job of positioning the NVIDIA partnership as the ace in the hole. That validation is crucial. But the connection between that win and the final stock price feels a bit conceptual.
That's the issue. The weakness is that it says the $2 billion market cap is a fraction of the size of peers. But the link between winning a small percent of the NVIDIA market and actually reaching that peer valuation is, well, it's abstract.
The significance is there, but the size of the prize isn't tied to a number.
It needs a bridge.
It needs a bridge. You have to translate this huge market opportunity, the 800-volt demand, into specific metrics that support the re-rating argument.
You have to ground the big narrative in company-specific potential.
Something an analyst can actually model.
So what's an actionable way to do that?
Okay, the analysis says mass revenue will hit in 2027, so you can use the multiples of its peers like Monolithic Power or Vicor to set a target, maybe an EV to sales multiple.
Okay.
Then you calculate what level of 2027 revenue from the AI segment alone would be needed to close, say, 50% of that valuation gap.
Ah, so it stops being they're cheap and becomes if they hit X dollars in AI revenue, they justify Y valuation.
Exactly. It makes the thesis quantifiable, which gives it so much more credibility.
Mm-hmm.
And we can go deeper on the tech, too. The report says GAN and SiC are the only two technologies capable of powering future AI.
That's a pretty powerful statement. It implies scarcity.
Extreme scarcity. So why should the re-rating wait until 2027? The argument should be that the scarcity of proven, validated suppliers in this mission-critical niche commands a premium now.
So you argue the multiples should expand based on their technological moat, not just based on trailing revenue.
Precisely, if you're one of the only companies validated by the market leader, that optionality alone justifies a higher multiple. The re-rating should start sooner. That really sharpens the timing of the argument. Okay, let's go to our third and final critique. Structuring the 2026 narrative to manage all this transition volatility. This one is all about pacing and investor psychology. I mean, the strategy of buying the Valley in late 2025 is analytically sound.
For a long-term investor, sure, but 2026 is going to be incredibly choppy.
And that's where the narrative has some tension. The analysis correctly says the stock price in 26 will move in anticipation of the 27 boom.
But then it also notes that the 2026 revenue itself will look optically low.
That juxtaposition is a gift to short sellers. It could easily cause impatient investors to see a bad print and just panic and sell.
Right before the real story kicks in.
So the structure needs to manage that tension. The suggestion is to rework that Why 2026 section to define the specific positive catalyst to watch for.
Leading indicators.
Exactly. Things like design wins, increasing order backlogs, milestones that will drive anticipation, completely separate from the lagging revenue figures. You have to shift the reader's focus away from the quarterly noise.
So you're creating a different scorecard for the market to follow, one focused on execution.
You can even segment the year. You could frame Q1 and Q2 as being focused on stabilizing things, getting some of those early industrial and EV contracts to put a floor under the numbers.
Okay, establishing a bottom. Then you shift the focus for Q3 and Q4 entirely to the big stuff, the announcement of NVIDIA-related design wins, the growth in the order book. That gives the reader quarterly milestones to track so they aren't blindsided by a low revenue number. It keeps them focused on the long game.
And to really defend that 2026 low, you have to bring back that $250 million in cash.
It can't just be a safety net.
No, you have to frame it as an explicit strategic asset.
How so?
That runway guarantees management can ignore the pressure to hit some quarterly number. It means they're not forced to chase bad, low-margin revenue.
They can afford to focus completely on the long-term, high-margin integration wins.
Exactly. The cash isn't just for survival. It's what enables the strategy. It provides structural insulation from that 2026 volatility.
That's a powerful point. It really elevates the cash from a balance sheet item to a core part of the thesis. You know, this entire report is strong. It's identified a really significant opportunity.
Absolutely. These points are about taking it to that next level of analytical depth.
So, to quickly summarize the actionable feedback.
First, you've got to integrate and neutralize the bear case. Explicitly address the real risks, like competition or that low Q4 guide carrying over.
Second, you need to quantify the valuation gap. Turn that NVIDIA partnership into a concrete revenue target that justifies a peer multiple.
And use the tech scarcity argument to justify why that re-rating should be happening now, not just in 2 years.
And third, you have to structure the 2026 story around leading indicators, design wins, orders, so the narrative isn't held hostage by optically low revenue.
And use that cash runway as a strategic defense for why management can afford to ignore that short-term noise.